or try to tailor the session today to all levels of understanding. So before we dive into the mode of today, let me briefly say a few words about carbon equity for those people who are new to carbon equity. My name is Jacqueline van den Ende. I'm one of the co-founders and the CEO of Carbon Equity. And Carbon Equity, in a nutshell, is a climate investing platform that affords you low minimum access to the world's best climate venture capital and private equity funds. And by making it possible for you to participate, to invest in breakthrough climate solutions, we want to accelerate the energy transition and also build thousands, if not tens of thousands of shareholders of the net zero economy in the process. So we stand for our mission at large is to move capital at scale towards climate technology, but also to take people with us. So we do a lot in terms of education, and hence today, the Climate Tech Outlook 2023. I'm super excited for this discussion. I think 2022 was, a good year for climate tech, a mixed bag for climate transition. If we look at climate tech in 2022, climate companies raised approximately $40 billion in funding, $40 billion in funding across 1,000 venture and growth stage deals. So that's quite a lot of money, slightly less than in 2021, but overall 40% more deals. So overall, if you look at the whole investment market, sort of imploded in last year, and climate tech was sort of the only shining exception to this overall downward trend. But 2022 was also a bit of a mixed bag for progress on climate transition. We all know, and especially in Europe, about the Ukraine war. Energy prices went absolutely through the roof. Inflation went through the roof. Interest rates went up. Companies doubled down on their climate policies. We had in the US a major milestone with the Inflation Reduction Act, a $369 billion stimulus package for climate solutions. So both highlights and lowlights in 2022. And in this session, we're going to reflect on what's ahead of us. And we don't have a crystal ball, but we have three absolute amazing experts in this session. The first expert on our panel is Matthew Norden. He is a general partner at Azolla Ventures. We are one of the proud investors in Azolla Ventures. We think it's an incredibly exciting fund. And Matthew has spent more than 2 decades investing in and focusing on cutting edge technologies as an investor and as an advisor and an analyst. And he is an accomplished speaker and commentator. Annika with us today, she is the chief economist of Van Lanschot Kempen, which is the leading private bank in the Netherlands, I might say. She has spent 13 years with Van Lanschot, before also spent time with Citigroup, KPMG, Rothschild, and Goldman Sachs. And Annika is also a very often featured speaker on the likes of Financial Times, Bloomberg, and CNBC. So really wonderful to have you. And Fabi, or Fabian, can I call you Fabi today?
Sure.
Okay. Fabian is a serial founder, a great inspiration to myself. He founded both Daily Deal and Forto, both unicorn companies. So he did it not once, but twice. And above that, he is a very active climate activist. He founded Leaders for Climate Action, a wonderful initiative to get companies to commit to climate goals and take action on climate goals. And he is currently the founder and the managing partner of Ainu Ventures. And Ainu is on a mission to become, the Europe's or perhaps the world's best evergreen green tech fund. So thank you so much for being here. I'll stop my screen so we can fully focus on the panel. So let's dive into the mode of this. And I wanted to start off talking about macroeconomic trends. We briefly introduced that just a while ago. Ukraine happened. Energy prices went through the roof. inflation went through the roof, interest rates were high, and that's having an effect on climate tech, obviously, and on the broader investment market. Annika, what are you seeing in your crystal ball, which I know you don't have, but what are you expecting in terms of key macroeconomic trends for 2023?
Yeah, thanks. Well, I'm glad you said I don't have a crystal ball, because we certainly don't. We can only talk about what we've observed, what one could expect given the things going on. And to your point, obviously the key topics are the inflationary environment, the interest rate environment. You know, the big topic in the markets right now is the sort of disconnect between what markets are hoping for in terms of interest rates and what the central banks that set the rates in the first place are citing. And to cut the long story short, markets are hoping that the interest rate increase that we've seen in the last couple of quarters is going to abate and actually reverse to be a decline in rates, so the famous pivot. Whereas central bankers are extremely stubborn. They say their fight is not over yet, and they're still very, very keen to continue their path of rate increases. And I think making the link between macroeconomics and obviously this panel, for me, the most important thing is just all about the cost of capital. Yes. And when you talk about investing in technologies and businesses, it's all about the difference. Every capital allocator is aware of this, whether you're an asset manager, whether you're a business operator, the difference between cost of capital, return on capital, cost of equity, and return on equity. And that equation is fundamentally different to what it was in the last couple of years. And we believe structurally, there's a real stickiness to that.
So, and if you say stickiness, we expect the cost of capital to be significantly higher or materially higher than it has been in the past couple of years.
Yeah, I mean, it's simply with these things in life, it's always the same. If you zoom out enough, you'll see that the last 5 to 10 years was an extraordinary period with extraordinarily low cost of capital. Yeah. And what we're now seeing is a revert back to simply normalization, which means certain business models are found and not found.
That is actually a very good point, that perhaps the bull run of 2020 to 2022 was an anomaly rather than the default that we sort of got used to, and sort of, everything was going up. Are the markets, if you look at, for example, public market sentiment, are they anticipating that the interest rates will go down, or not just yet?
Yeah, so if you look at markets, it's quite fascinating, because there's this sort of schizophrenia going on, and markets are essentially looking for clues. So every time some central banker sneezes, everybody sort of tries to derive clues out of it. But if you're very practical about it, so in Europe, markets were hoping that European rates would, the steep of increase of rates, the slope would start to slow down. Then Lagarde, chairman, speaks in December, and suddenly rate expectations go up. Yes. In the US, the market's actually expecting that rates are going to go down in second half 2023. And the Fed is saying, well, we don't agree. So that's indeed the mismatch that I was referring to.
Yeah, exactly. Yeah, and there has been quite a lot of talk about recession. A lot of people speculating that there might be a minor recession, or potentially even a deeper recession in Europe, at least. What is your stance or expectations in terms of whether a recession will hit in Europe, or specifically in the Netherlands, and what the impact of that might be, if ever, if any, on the investment markets?
Yeah, well, I think the funny thing about recession, so we're all obsessed with recession, right? So every single pundit, major bank, major outlook provider is talking about recession, recession, recession. I think the first point is, how do we want to define the word recession? Do we define it using an economic textbook, which is 2 quarters of decline in GDP? Do we talk about it in terms of sentiment, how real people are feeling? I think that's very, very important. But if you use sort of textbook definitions and you see what everybody is talking about, I mean, it's absolute consensus that we will see a recession in 2023 for Europe, for the US, including the Netherlands. Mm-hmm. I think what's more important than that is thinking about, and why. I mean, you have to look at leading indicators. So obviously, not only current economic information, but all the leading indicators. I mean, across the globe, essentially, especially the developing countries, all the manufacturing services leading indicators are in contraction mode. We've had 7 consecutive months of that.
Wow.
So it is the recessionary environment people are talking about. But on the other hand, we all know it, we're all aware of it. I think it's simply a case of there's been a lot of free riding. You spoke about the bull market wave. There's been a lot of free riding of this great bull market wave, hot economy, amazing labor market, free money was plastered everywhere, easier to fund certain initiatives if they were riding certain momentum waves. Yeah. And I think just structurally, you talk about the anomaly versus normalization. Yeah. We have to get our heads over the fact that that wave that we've been surfing on is over. It doesn't mean that it's all doom and gloom. Yeah. It just takes a lot more nitty gritty work to figure out where one should invest and one shouldn't.
Back to the new normal. Thank you very much. Yeah, that really puts things in context for me. Matthew, Fabi, I would like to talk about what we expect these macroeconomic conditions, how we expect these to affect the investment in and also the adoption of climate technologies. And also there we've seen a bit of a mixed bag. I think on the one hand, we saw a lot of stimulus for climate solutions in 2022. Energy security became a super important policy objective, and obviously renewables, local renewables, are an important weapon in ensuring energy independence for countries. The prices of fossil fuels went up, that made PV, solar PV and wind much more competitive. We're starting to see much more geopolitical competition to attract climate industries to different countries. So we're seeing different trends. On the other hand, we saw also much more investment into oil and gas, which was quite stunning. Something I didn't know, but in 2022, apparently 15 new greenfield oil and gas projects were funded to the amount of 42 billion, which is the total amount of the 4 previous years. So more than 4 times the previous 4-year capex spend was invested into oil and gas. So we're seeing more renewables, but we're also seeing more oil and gas, unfortunately. What do you expect the over impact of these energy trends to be on the energy transition? Are we accelerating the energy transition, or are we potentially falling behind? Matthew, may I first ask you for your read of the situation?
Sure, and then Jacqueline, I don't know if you've thought if this whole fund of funds thing doesn't work out, you should be a talk show host somewhere. You do it.
Yeah.
I think we always have to consider people's biases, and Annika is probably the person in this panel who has the most macro level view. Our investment strategy is a bit of a weird one, right? We are first institutional capital investing super early, very high risk, very high reward, only in things that could be true climate breakthroughs that could have gigaton scale impact on net emissions by 2050. And that means that our time horizons are quite long, and we expect companies that we invest in to be moving at some point during their lives before they reach impact at scale and hopefully an independent life as public companies to go through at least one macro cycle gyration. Yes. So we tend to be a little bit less sensitive to sort of macro conditions and how, cost of capital, at least at later stages of finance, particularly for debt, will impact our portfolio companies because frankly, at the point that we get involved, that's going to be many years away.
Yes.
I do think an environment like this one, and I'm sure Fabian, will have an equally rich point of view on this, really does enforce discipline. I think that as a ton of capital rushed in, particularly at the early stages in this field in the last few years, and hot deals, deal is a banned word in our shop. Companies are not deals, people are not deals, but what the rest of the world uses, got chased and valuations got bid up dramatically, particularly in areas that captured the moment, like hydrogen and weirdly enough, nuclear fusion. I never thought I'd be saying those words in that order. I think a lack of discipline, particularly at the early stages, meant that investors could establish an extraordinarily high basis that would make it difficult to achieve a venture return. I also think the other aspect of discipline is being disciplined about not seeing the world through rose-colored glasses. For example, between our first fund, Prime Impact Fund, and our current fund, Azula Ventures, and thank you for your support of our climate mission there, we have invested now in 5, about to be 6 companies that are one flavor of another of carbon removal. But we've got to have a high degree of discipline only to invest in cases where that's not going to be the only line on the income statement. The companies have a secondary value proposition. I mean, they have another source of revenue that's not solely credits, which may more ebb and flow at the time. The last thing I would get across, though, is that your point about oil and gas, this is really important.
Yeah.
I think you can't look with clear eyes at any net zero global set of assumptions, and I would really put, the IEA's 2030 assumptions here, to believe that they are in any way realistic.
Yeah.
Reaching those targets requires industrial policy decisions in countries that are not going to sit at the back of the bus because they happen to get rich last, namely China and India, to radically decarbonize not only electricity, but things like industrial process heat that just aren't economic to do.
Yeah.
And I think we really need to check ourselves about whether we are building expectations that are in any way likely to occur, and redouble how we think about investing in breakthrough innovation that really would pull a rabbit out of the hat.
Yeah, absolutely. Fabi, what are you seeing in Europe to the point of valuations, a lot of capital rushing into the market in 2020, 2021, in the very long bull run? Are valuations starting to normalize, come down, perhaps even? What are you observing in terms of, the European landscape?
Yeah, no, I mean, when we look down or when we look from a top-down point of view, as you cited, 2021, about 500 billion of global capital intake, about 100 billion of that in Europe, all-time record, coming from more like 250 million in the years prior. Last year, 2022, we have been basically backing down to these 280, 300 million range. And we believe that this downward trend globally, but also for Europe, the US and Europe have been largely correlated here in the upswing and also downswing. We believe that this downwards trend is going to continue at minimum for another 3 to 4 quarters, so throughout 2023, but likely also into H1 2024. And in other words, our house view is that we believe in a multi-year U-shaped recovery, somewhat similar to what we saw in the aftermath of global financial crisis after 2008, but also hopefully not as stretched out as what we saw after 2001. And we believe that 2023 will come in around 200, 220 million before 2024 might then pick up on an annual basis. I mean, so that's, I'd say.
We expect to see investment really decline and also potentially valuations decline before it goes up again.
Exactly. Or speaking of the VC or technology equity landscape per se. Now, as you said, or you hinted at that, when we look into the data on a more granular or sector level, we see that the year-over-year and quarter-over-quarter declines in the past 6-7 quarters in fintech, in commerce, etc., were quite dramatic, between, let's say, 25 and 40, 50%, depending which subsector you're looking at. However, climate tech, and when we take climate tech maybe as a proxy for impact technology per se, or its biggest vertical, climate tech has been fairly resilient to that downtrend. And that's exactly, I mean, as you say, so to say, the macro headwinds that the whole sector experiences, but then the micro tailwinds from, regulatory EU Green New Deal, IRA now kicking in, but also shift in consumer demand, corporate agenda, and so on, but also generalist players starting climate tech practices and starting to allocate 5, 10, 15%, partially also, intrinsically motivated, partially also potentially because they feel pressure from their LPs that increasingly want to disassociate themselves from Article 6 strategies and gravitate towards Article 8 or even Article 9. So therefore, I'd say, looking at climate tech specifically, we are still somewhat sheltered from the very difficult quarters that are ahead of tech in general. However, then on the next level, and that's also comes into play for our own portfolio construction and thinking of risk here in short and midterm, this raises questions on, what exposure on deep tech hardware do you think you can sustain as a manager versus on the more asset light, easier to bridge, easier to reduce burn and stretch runway if necessary, a type of software and platform businesses. And we believe that the ongoing lowering or basically cutting back of valuations and round sizes will also be much more pronounced on anything Series B and up than in pre-seed or seed.
Yeah.
And that has also with many managers, and that includes also tactically Anu here, that has caused many managers to refocus on rather going earlier stage. Where there's less dependency, like Matt said, on also on the immediate cost of capital and maturity is more into or even throughout the next cycle. Yeah, then going into any growth stage pre-IPO, like these are the areas that are truly distressed at the moment.
Yeah, exactly. Okay, so we're expecting to see a bigger hit in terms of valuations and less capital available for growth stage deals, but VC to be a little bit more sheltered from that, if I hear you correctly. Yeah. And so you invest in early stage deals. May I say seed, Series A, correct?
That's correct. Yeah.
Are you seeing lower or more realistic expectations when talking to founders in terms of valuations, or not yet? Is there still sort of a lag in terms of the founders catching on? Okay, we have a new reality.
Yeah, I'd say that you are addressing me, right? Or
yes.
Right now. No, certainly. So there is a certain disconnect in the market, and that is basically, I think, due to the lack of adaptation speed, so to say, to the new reality, where the investors tend to adapt much faster than the founders, and some founders clearly still kind of, I don't want to say stuck in 2021, but they have expectations that are detached from the market realities, and that goes basically in two dimensions. So on the one hand side, rounds are getting smaller, but also dilution is getting bigger. Yeah. So when in Europe, an average seed round came in at say 16 to 20% dilution in 2020 or 2021. Now we see those rounds coming in at 22 to 28% dilution, and then fully diluted with VSOP top-ups, sometimes even exceeding 30%, which I think 30% is kind of a border also for us. When you think of maintaining a healthy cap table, that's in the other end of the spectrum. Yeah, how do you strike the balance between a healthy cap table, incentivization, but also not going overboard like it has been in 2021. Yeah, so it's if you will, a recalibration or re-education also in the making. Yeah.
Fabi, as a former founder, what would be your advice to founders in terms of fundraising at the moment?
Well, let's say those founders who don't have to raise in 2023, they just don't do it. Yeah. So ideally, you're in a position where you have made your company watertight already over the past 12 months and can wait towards first or second half of 2024, having a good likelihood that market sentiment will not be crazy bullish, but not as distressed as it is at the moment. Yeah. Generally, Matt mentioned it on the manager side, discipline. Yeah, and that's the same basically on the founder side. So cash is king, being super mindful of your runway, being super mindful of your fixed costs, and dynamically also touching or adjusting your variable costs. Being sensitive to cash burn, being sensitive to capital efficient growth when you look at ratios like burn rate to top line, burn rate to gross margin, etc. Yeah, no one will cheer you for hyper growth at a crazy burn rate. Yeah, these days times have changed, and it's much more going back to fundamental health. Proving unit economics as early as you can, even if you're growing only 100% or 200% year over year. So this is basically currently the name of the game. Yeah, and I think it's good. The years. I've been for 10 years now on the VC side after 12 years as on the founder or CEO side. The years 2018 to 2021 were insane. VCs weren't doing diligences anymore. Deals were preempted. It was. I don't want to say gambling, but it was basically an unhealthy basis of decision making in VC going on, and it's good that this is basically now being reset to a more diligent, more fundamentally driven approach.
It's really interesting how we go in waves. Even in the 10 years that I've been in this space, I've really seen the focus shift from some moments that it's all in on growth, and other moments like, no, a profit, purely unit economics over growth. And now we're back to the phase that business needs to be fundamentally healthy. That is the name of the game. So Annika just referred to 20, like the whole bull market being more of an anomaly than the normal. And now with higher interest rates, at some point the interest rates were so low, even negative, that anything could get funded. And now that reality has changed. Matthew, what are the types of innovations that you feel, got funded that should not have gotten funded in the past exactly because of these very low interest rates? Sorry, that's a spicy question.
That is a spicy question. I gotta make sure I don't offend somebody here. So look, there is one aspect of this that are categories that are possibly fundamentally bad ideas. There's an aspect of this that are categories that have now far too many players than there's going to be capital available. And then there's an aspect about things going in cycles. I would say on the first part, there are, in an environment where, for example, there's enormous interest in grid scale energy storage, we are seeing a lot of ideas be dusted off that have been tried in some cases for some battery chemistries going back a century or more.
Okay.
And have never worked for pretty well understood reasons. But whenever you get a rush of capital into an area and a lot of managers, LPs, entrepreneurs, partners, where something isn't new, but it's new to them, you tend to see these decade or 2 decade cycles, when kind of has-beens and never will be's get a fresh round of investment, and you're baffled if you've been in the field for a while on them suddenly being a hot new thing.
Yeah,
I think we've seen that in grid scale storage. I think we've seen a great amount of that in biosciences, and particularly in genetic traits for yield enhancement in food crops or in other types of crops.
Yeah.
For example, crops that might be used for carbon capture. So I think those are some examples of areas that I think we will look back on with more sober eyes in 5 or 10 years and think, wow, we probably owned gold that one. We probably could have known. Those are things we try to avoid in our team.
Yeah.
Areas that just have too much. This is predictable. I think there was a point where if you could stumble around while saying the word hydrogen, above 50 decibels or so in Europe, you were likely to get your company funded, on the streets of a metropolis. And that's understandable, right? The accelerated transition that we've seen very sadly, and somewhat uniquely as a result of the Ukraine war, meant that really any rapidly deployable alternative low density gaseous fuel could be put into existing natural gas pipelines was going to get an audience. And as a result, there are probably 5 times, 10 times, more companies that are going to make it to the next round of financing. Again, discipline's pretty important here. Yeah. And the last one, things going in and out of fashion, this particularly hits us because, one of our key evaluation criteria is this principle of additionality. Not only do we prefer not to chase hot deals, we are mandated in our LPA, as you know well, that we can't do that. We have a partnership with a 501c3 nonprofit partner called Prime Coalition that gives us advice based on a range of inputs, including from a panel of mainstream VCs, as to whether something really needs us in order to have its round led or filled out or not. And we don't participate in things that don't meet that test. And it's one where we're not grading ourselves. I would note that there are areas that have gotten out of fashion that are probably unfairly out of fashion.
Okay, that's interesting. I'm listening.
One really good example of this would be anything related to solar hardware, where I think the world has basically concluded that between silicon perovskites, a range of low E coatings, other types of coatings, that the solution is made. There is a whole different solution space of ways of converting light in the electromagnetic spectrum to motion of electrons that are not photochemical, that don't involve photons hitting a material and separating electrons in holes, things like solar antennae, for example. Just have kind of been left for dead, and the investment landscape has the tide completely out the way it might have looked in the early 2010s. I think anything in computing that is not quantum or cooling has kind of been left for dead. And there are, again, entirely different paradigms that could have an inherently lower watt hour per compute cycle, or per memory bit written entitlement, things like reversible computing that just aren't getting attention either. These are the areas we're spending a lot of time on.
Yeah, interesting. So a couple of takeaways here for me. First, investors should be historians. We should read the history books well and understand the cycles that repeat and the mistakes that are made time and time again. And secondly, we should be looking for the cold areas, not the hot areas, to find uncompetitive and potentially very interesting deals here. Annika, back to you for a moment. How in general are you seeing the climate investment space evolve and mature? What structural trends are you seeing in the way that capital allocators are looking at this climate investment space?
Yeah, well, I think my fellow panelists have already alluded to this. So on one hand, we have to be very aware of what's happening in the macro world and, cost of capital, because it's intrinsic to business models. On the other hand, you can also say, who cares? Because, to the point that's already been made, we're talking about long-term, structural shifts, seismic shifts, long-term businesses that need to create value, etc. So in that sense, the macro story is more of, is there headwind or is there tailwind, right?
Yeah.
And I think to answer your question, if you think about the world of capital allocation, and I'm not just talking about targeted funds only on, for example, climate tech, I'm talking the aggregate layer. What you see in general is there is a structural shift, there is a seismic shift. So it used to always be about the parameters of risk reward. Mm-hmm. There's a third axis added to that. It's risk reward impact. And it's impossible to deny that, regardless of what specific strategy or sector bias a certain asset allocator has. Why? It's not just about altruism, it's just capitalism, right? I mean, because in the past, it was very much, here's a list of companies that do harm, a large bunch of those should be, written off from exclusions, and here's a bunch of companies that have positive impact. But that leaves a huge range of companies, which is probably the majority, lying in the middle. Yeah. Well, what's the game plan there? How do you navigate which companies? And ultimately, the reason why impact is the third axis, which is, it's the holistic way of looking. And I think a lot of managers are already thinking in this way, and those that aren't need to wake up, because it's the reality. Mm-hmm. There, it's about identifying also in the middle camp. So to what you mentioned earlier, not only the obvious positive impact companies, which of those companies are going to be the winners based on what's happening in the world. So if you think about the basic stuff, like what determines whether a company is a high quality company. Yeah. Climate, sustainability, ESG, that's totally part of that definition now, because a really good company is a company that should be able to justify its rights of existence today and next year, not because it generated a lot of cash flows over the last 10 years, because things are changing.
Yeah, exactly. In that sense, you're really seeing a bit of an evolution from in the beginning, anything ESG was wonderful and people were not really asking any critical questions. And then people started wondering, what is ESG truly? And now people are starting to get more and more critical on, okay, you say it's impact, but what is the impact that exactly I am having here? Yeah. I'm curious to know, Fabi, you've been investing for 10 years. Matthew, I think you for even almost 20 years. Personal question, how have you evolved as an impact investor, or what have been your biggest lesson in successfully being an impact investor? Fabi, can I start with you?
Yeah, no, sure. I mean, maybe to give you a bit of context here, I mean, my brother and I, these small town country boys, grew up near Hanover, Germany, and started our first business, which was basically a food truck for French waffles in 1999, 2000, we were 14 and 17 years old.
How old are you?
And then I'm 40 now.
No, but you were then 17.
I was 17, yeah. I was, my first career, I was trying to become a professional windsurfer. I was in the German national team, went to Hawaii to boarding school, then got injured. And so that career failed. And then my entrepreneurial career started. And so, through law school, business school, etc., spent some time in Silicon Valley, intersected with the tech industry. And then 2007, dived into the Berlin ecosystem. Not much of a clue, no family business background or wealth, and just, went for it and had a couple of failures. Then, as you said, Daily Deal, sold that to Google, which is backed by Insight. Later started Forto, backed by SoftBank, that logistics tech unicorn. But basically up until 2015-ish, we were operating in the classical kind of Adam Smith liberal capitalism definition of success, which evolved around basically generating wealth for ourselves, for our investors, generating some jobs, paying some taxes, but basically generating wealth. Yeah. And only after having, if you will, reached a certain milestones as entrepreneurs, and by that time I was already had started doing angel and business and super angel investments for a few years on the side. Only then we at some point came to this point where we had a kind of a loss of, I don't want to say loss of purpose, because that purpose was very narrow back then, or maybe in today's definition wasn't even a purpose. Yeah. But we were basically questioning how our actions contribute on a greater scale. And that's basically 6-7 years ago where, if you will, our impact journey started. And climate crisis was that first focal point, and at first we worked in concentric circles and changed our lifestyle, switched to cargo bike and electric car, and I was a pilot, sold my plane, became vegetarian, switched to our houses to renewable energy, and so on, like the obvious small stuff, like tens of tons, but not hundreds or megatons. Yeah. And then we went on and said, okay, what's the bigger lever? Yeah. And then we went on looking for the bigger lever and looked into our companies, how can we change policies, travel, energy, and so on. How can we measure and reduce footprint? And we went on. I was then a general partner at Earlybird. How can we multiply these frameworks into the portfolio? There was thousands of employees, and we started Leaders for Climate Action as a nonprofit to basically spread these frameworks for measurement and reduction and also high quality offsetting into the tech ecosystem. Today, 1,700 companies, I'm putting it here on the chat, lfca.earth, have joined this movement free of charge. It's a nonprofit. And then I started the climate tech practice to basically merge the for-profit and climate sides of my life at Earlybird 3 years ago. And then ultimately we came to realize Earlybird, 2 billion assets under management, successful generalist firm, but we cannot pivot that firm with so many stakeholders at the table into a proper Article 9 strategy. And that's when a new basically emerged, and where we realized we don't want to live in those silos with Forto and Earlybird at these profit centers, and then all of these founders pledge LFCA nonprofit activities. And so we basically, we came up with a strategy where we could spend our whole lives executing on a strategy that would be fully aligned with our point of view that had evolved over time, really. And 20 years ago, we were at a completely different spot in our life.
That's beautiful. Thank you for sharing. I think that reminds a lot of people. I imagine a lot of people in this webinar as well are on their personal impact journey and going through several stages of first the low-hanging fruit, what can I do in my own environment, into ultimately merging your career and what you do, what you spend your time on every day, and aligning that entirely with impact. I want to go to an audience question. So I'm getting a also spicy question on US versus Europe dynamics. And the question is as follows: any views on whether the US will outpace Europe on climate tech, or can Europe keep up? The IRA, the Inflation Reduction Act, has created major tailwinds in the US, but now there's talk about a potential net zero industry act in Europe, which is going to be sort of the European version of the IRA. So who is gonna win? I'm gonna say I think the fact that we have a battle going on here is a good thing, first and foremost. But Matthew, what's your perspective? Is the US ahead and gonna stay ahead, or do you feel Europe is catching up there?
Yeah, I lived in the Netherlands for many years, and then you come back to the US and go to a grocery store and you realize the cereal starts here and ends there, and you realize how big these differences are. I think you have to think about that on a few dimensions. In terms of just kind of raw startup creation, funding volumes, number of companies, particularly at the early stage, I do think there is, and this is going to change over time, right? It's changed historically, a supportive culture and ecosystem of translating deep tech research out of university settings into startups. That is somewhat unique in the US. When it comes to deployment and adoption, I think there are areas, and hydrogen, as we spoke about beforehand, is a great example of one, where the US will be an also-ran market forever.
Yeah.
When I think, though, about the nature of the question, I think we have to think about it a little bit more globally. One of the unspoken stories, of the last decade or so is that a completely different startup culture, method of funding, method of adoption has arisen in China.
Yes.
Lies entirely outside and has led to global leadership, particularly in the most advanced area, in my view, of the energy transition, the electrification of vehicles.
Super good.
Where there's a completely different universe, network, set of funding mechanisms, tech stack, et cetera, that I expect to continue.
Yeah.
And I think there are aspects of that we see now popping up in other places of the world, most notably sub-Saharan Africa, where the innovations in mobile payment and fintech that were kind of low-end, bottom-up disruptions that are now models for much of the rest of the world, I think you will see in other areas ranging from microgrids to microtransport.
Yeah.
So we probably need to have, a broader view of what the global dynamics are in innovation versus adoption.
Yeah, that's an excellent point. That's very much counts China as one of really the front runners in the whole climate technology race. They are moving really fast and very aggressively on specific industries. I'm seeing increasingly many Chinese cars drive around in Europe as well. And I think overall for the whole energy transition, that is a great thing. Fabi, what are you seeing in terms of Europe versus US dynamic? I imagine you have quite some experience on both sides of the Atlantic. What is different, and who's ahead?
Oh, yeah. So, maybe putting IRA aside for now, and also, in that context, also with the European Green New Deal, we try always, like Matt said it, we try to take a very long-term view and look through potential subsidies and short-term tailwinds to the fundamental health or not health and sustainability of the underlying technology and business models, and basically looking for those who can achieve price and feature parity in whatever product or sector in the long run. Generally, these days, at ANU, our focus is early stage Europe, where we increasingly co-lead, also lead the rounds. But we also have that pocket. My brother, he's based on the US East Coast near Boston, Portland. We have that US pocket where we co-invest with Lower Carbon and Breakthrough and NEA and USV Climate and so on, but mostly in follower roles where we help those companies have a strong domestic lead and help those companies then enter Europe on a biz dev, talent, sales perspective.
Yeah.
And by and large, also when you look at our current portfolio, almost all of our carbon removal investments are based in the US, for example. Yeah. And
why is that?
believe,
yeah,
it's a good question, but I believe that the relatively less mature European VC ecosystem, there are fewer players who dare to touch deep tech and hardware and who dare to take the longer development cycles, longer time to market, all the issues with a 10-year fund cycle, which led us to set up the semi-liquid evergreen structure to be able to partner also for 12, 15, 18 years, as long as the equity story is intact, and be a true long-term partner for the entrepreneur. All of these aspects, I think, are coming together, and European VCs are more afraid of committing mistakes. Yeah. Also, the LP market is much more LP friendly than GP friendly than in the US, from my point of view. So I think there's many, and then also, look at Bezos, look at Gates. That's just crazy rich people in the US who put substantial parts of their private wealth into jumpstarting funds like Breakthrough Energy. That's not happening in the EU. So there's a multitude of factors. Yeah. Also more of a, if you will, like cowboy boulder mentality in USVC that actually leads to that we generally see a stronger or a bigger degree. Also Zero Avia, for example, that had its maiden flight for the 20-seater hydrogen electric aircraft from our portfolio last week, basically could not have happened in EU from my point of view. Yeah. So hardware stronger in the US, and then in Europe you see a lot of SaaS companies, climate fintech. Also, I'd say the more asset-light home decarbonization plays. There are good, also technically leading vertical farming companies. We just invested in biodiversity, MRV. I think generally also biodiversity is another very connected into climate tech, or however you put it structurally, but interconnected. Another big topic for us and for the sector in this year and the coming years. So yeah, it remains to be seen how it shapes up. But I wish there were more bolder investors in Europe. And also alongside bolder investors on the equity and early stage and growth stage equity impact venture capital side, we also still lack the surrounding infrastructure for the deep tech and hardware ecosystem. Speaking of project finance platforms that actually can move substantial amounts of capital, mezzanine, we are looking like for a new, we're now actually trying to build an ecosystem with bank partners, mezz partners, etc., to cater that or to give that basically to the respective companies in need. But this is all very nascent. This is really, in development. It will take years to mature.
I totally agree. That's also very much what we see, that US is culturally more inclined to taking bigger bets, more risky things, more capital intensive type investments, versus Europe that is culturally a lot more conservative and also indeed doesn't really have the ecosystem as well set up as in the US. Cool. I want to talk finally, and we're getting towards the end. So final question to you from me, and then I'll entertain a couple more Q&A questions from the audience. What's hot and what's not in 2023? So I'd like to ask you all. And Matthew, perhaps you can continue on what you were discussing before, where you see the biggest opportunities and the areas that you are not interested in 2023.
Yeah, a few things. From a sort of size and stage perspective, I think there have been a number of kind of mega growth rounds of companies that have occurred over the last few years. We're fueled in some ways by what I'll refer to as tourists, usually alternative asset managers, aka hedge funds, who saw the activity happening in climate, and I think they have left the room as quickly as they came in over the last 2 years. So we're going to see less of that, and we'll see sort of more long-term patient financiers with a lot of family office money, a lot of endowment money, and a lot of strategic money being involved in growth rounds of companies that are getting across the chasm. I also think sort of hyper-sized pre-seed, seed, Series A rounds are also likely out the window. We're seeing that already occurring. In terms of domains, strangely enough, it's one of those things where there's a lag effect based on what happened before. I think there will continue to be a great amount of interest in nuclear fusion, although it is not important from a commercial perspective. The kind of science achievement that occurred at the laser ignition facility in the US late last year, that was the first time our species reached Q/1 and made more power out than we did.
Maybe just for the less informed people in the room, because that was a huge breakthrough.
Power out at the top, power in at the bottom. And this is the first time that number was greater than 1, that ratio. But it doesn't matter, as a facility that, used lasers the size of 4 football pitches to make power that is the amount that would come out of your hairdryer. So it doesn't really matter. But I think that occurring and the progress that a number of private fusion initiatives, including one of our portfolio companies, Avalanche Energy, that's doing this at a radically small scale, will make that a continued area of a lot of interest in the course of the next year or two. And I think anything that touches the issues around the accelerated transition, particularly around building energy usage and natural gas replacements, in Europe is going to be a very big deal. Areas that the other thing that I think it would be interesting to see this year is that I think we will see our first mega deal in carbon removal. We're involved in enough of these companies. We know what their business dev pipelines look like. But I think this will be the first time you see a contracted number in 2023 not be for thousands of tons of removal in the next year for $1 million or millions of dollars, but in tens or hundreds of thousands of tons in removal over a 10-year agreement with a tens of millions of dollars or more contract value. And I will bet you will see that converge before December 31st.
You seem to have some inside information. That's no, I can totally imagine. That sounds super exciting. Thank you. Annika, this is perhaps a little bit out of your domain and too much into the climate tech domain, but do you have a hunch for what will be hot and what will be not in 2023?
Yeah, well, I'll talk a little bit more big picture, but I think what I spoke about earlier, which was, that the companies that do harm, the impact companies, climate tech companies is an example of that, and then the stuff in the middle. And I think because the volume of companies is the pile in the middle, I think the most important trend for this year is regulatory driving, information, sort of common language and transparency. And why is it so important also for the impact, the positive impact companies, is because this bunch of companies in between are often the customers of the impact companies, right? Yeah. So they need to fuel the revenue growth and opportunities for that camp. And essentially also, we spoke earlier about US and Europe. I mean, the only sort of positive card I would like to throw out there is from a regulatory perspective, Europe has been massively front running, right? Now geopolitical stuff is coming in and, one nation is competing with the other, that's fine. Yeah. But the regulatory side has been very, very helpful because it's forcing capital allocators to really assess what is the impact that they're making on their investments, whether they like it or not. I think that's very important. Another thing that regulation is driving or is forcing the drive is more of a common language, basic stuff like carbon pricing, which in Europe has really taken steps forward versus the US, for example. So I think that's very, very important. The ability to measure what's actually going on, to track what's actually going on, and therefore, as a consequence, what valuations of companies should be.
Yeah, exactly. Yeah, thank you. Very good point. Let me entertain in the final 5 minutes a couple of audience questions. One question here, what do you think will happen to the carbon offset space in the wake of Guardian's recent report that up to 90% of offsets might be worthless? Will there be knock-on effects on carbon capture or carbon prices? Fabi, do you have an opinion on this question?
Yeah, no, I mean, that's tragic. And I read through the articles. It was if you will, Guardian in cooperation with the German Times, with Vera and also Pashama in the headlines. That's first of all tragic to see how basically, with generally, I would say, let's assume good intentions, even with these players that have been involved there, how unfortunate it is that so much damage has been created reputationally to the voluntary carbon market with these basically scandals around inferior or scientifically inferior measurement, reporting, verification methodology. I think this is also hinting. I mean, when you look at the history of Vera, also as a, if you will, a multi-corporate kind of, not really independent institution, this is hinting at the importance of regulation and standardization for impact measurement, not only in nature-based carbon credits, but also across the industry by and large. And I think this will also be key to making Article 9 not only in VC but also say in affordable housing or in real assets, energy infra, etc. Across asset classes, making Article 9 more mainstream and increasing the acceptance, especially also with the institutional investor market, and avoiding scam on the retail investor market. The importance of standardization and widely accepted, basically the IFRS or the US GAAP for impact measurement, getting there faster and not having individual players, so to say, setting de facto standards with conflicts of interest, that then others followed, in fact, in the market. I think this is for me the learning from this Vera Pashama scandal, and I think this is an ecosystem effort, or where we also at ANU, I can say we do have basically also a political agenda and try to back channel into German but also European level to push to advance standardization and contribute from our in-house impact team with ideas and frameworks, and we need to make this a collective effort, because without the IFRS or US GAAP degree of standardization and MRV, there will always be risk of incurring other scandals, and we're just shooting ourselves in the foot. by by giving those laggards out there in the industry arguments to say, I'm not considering to voluntarily offset, and it's tragic.
Yeah, also very much what Annika is referring to. It's the ecosystem maturing, right? So we start off with 0 standards, and now we're starting to work towards, and then there were many standards, all companies setting themselves different standards for what are good carbon offsets, and now start to see more homogenization, also politics starting to step in to set political standards, which I think is a good one. One final question from the audience. Where the pathway in energy is relatively clear, the next biggest system, agri-food, is still uncertain and divided. Do you have any strong views on the role and focus of food tech in the coming years? Matthew, may I ask you to jump in on this one?
Yeah, we're very thesis-driven investors. And the very first deep thesis that we did was about food and ag. We're revisiting it now, just because, depending on how you track the numbers, this is the largest, single value chain when it comes to greenhouse gas emissions, responsible for north of 25% globally. I would say that because of just sort of the sheer waterfront to cover, right? Of course, food and ag is going to be tremendously important in achieving our climate goals. I think there are 2 facets, though, that are important to get across. One of them is that it's complicated.
Yeah.
We got very excited early on about yield enhancement companies that aimed to introduce traits.
They increase the yield of a farm, for example.
Exactly. Same inputs, more crop.
Yeah.
The same land, same nutrients, same water, more crop. We got very excited about that. And when you drill down into it, very few yield enhancements, whether they are solely about, more tomatoes or about things like salt tolerance, are practical in the real world.
Yeah.
Because in reality, agriculture is highly optimized, strains are highly optimized, practices, be they conventional or organic, are highly optimized, and introducing something new that doesn't have an offsetting, yield loss based on the practices that have to change is just extremely rare. That's just one example, but I think in general, we need to take a skeptical eye, to interventions in ag because of the systems level dynamics we have to think about.
Yeah.
The second one would be, I do think there is a real risk that we could solve the climate while wrecking biodiversity.
Yes. Oh, great. Yeah.
And whether it is about, interventions to store carbon, that would, yield to increasing monocultures, either in the ocean or on the land, or anything that is in food and ag proper. I really think that more sophisticated and in particular downstream investors are thinking about this at a system level and about impact described more broadly than an emissions reduction alone. And knowing that that's the world we will be increasingly entering, that's the lens that we take to looking at new investments here at the earliest stages.
Yeah, good point. It's an important point on that. We also need to start looking at investment deals and impact more holistically. So not a single focus on carbon, but also more the systemic impact, also affecting biodiversity. And so we need a yet broader view than purely the climate lens when thinking about impact. Unfortunately, we are not able to go through all of the questions. Thank you so much for being such an engaged audience. I would like to thank our speakers, Annika, Matthew, and Fabian. It was a great pleasure having you on the show. I got one more question on somebody hoping to learn a little bit more about what carbon equity does. I will share a final slide with you. And so if you want to drop off, that is fine. If you want to learn a little bit more about what carbon equity does in a final minute, stay on. Annika, Fabi, and Matthew, again, thank you so much. It was great having your insights, and I hope people can reach out to you potentially through LinkedIn to connect. So finally then on carbon equity, thank you.
My pleasure.
Pleasure having you. Thank you, Annika. So carbon equity makes it possible for people to invest in climate technology venture capital funds, both venture capital and growth equity funds from low minima. At Carbon Equity, you can invest in a single fund or in a fund of funds. So you should see us as a curated marketplace of top climate funds, such as Azola Ventures and perhaps also I Know Ventures in the past. Typically, you need 5 million and above to be able to participate in these funds, and Carbon Equity lowers these minima. We last year had the minimum at 100,000 euros. Even we launched the Climate Investment Club that opened up access from 10,000 euros. And next year, the flagship fund of funds will be accessible from 50,000 euros. So our mission is to lower access. Our value proposition is that you get absolutely unique access, the unique possibility to participate in top funds that normally you would not be able to get into. And because you can invest from low minima, or because you can invest in a fund of funds, you get the diversification. So you're not investing in a single company, not in 20 companies, you're investing in 200 companies. So you're basically investing in the whole ecosystem of climate technology, which makes it a much less risky way of investing in these type of climate innovations. And lastly, what we try to do is to make this tangible. So through the app, you can see exactly what companies are invested in, what they do. You'll have a news feed. So for us, taking you along on this journey and helping you educate about what's happening in climate tech, and there's so much exciting things happening, is part of our value proposition. So if you'd like to learn more, feel free to reach out to us through invest@carbonequity.com or check out the website. We are going to launch our next flagship fund of funds in 2 weeks. So stay tuned. It will be a really cool opportunity to invest in 150 to 250 climate technology companies. So stay tuned for more information. Thank you so much for being with us today. Please feel free to rewatch or share the recording, and we hope to see you at a future event. Thank you.